Hello traders, join us in this video as we discuss the best approach to trade GDP news in Forex trading or when trading Forex. We begin by outlining that trading GDP news in the Forex market demands a comprehensive understanding of economic indicators and also their implications for currency valuations. GDP figures, which are released by central banks on a quarterly basis, serve as vital metrics for assessing the health and trajectory of a country's economy. By analyzing GDP data and also anticipating its impact on currency markets, traders or forex traders can capitalize on market opportunities and, more so, navigate fluctuations with greater confidence. At its core, GDP represents the total monetary value of all goods and services produced within a country's borders of a specified period, typically on a quarter or a yearly period. It is therefore it is a comprehensive measure of economic activity and serves as a barometer of a nation's economic health. GDP growth or decline reflects changes in economic output and provides insights into trends such as consumption, investment, and trade dynamics. That is in a given country. GDP growth is crucial for forex traders and market participants as it directly impacts currency valuations. A growing GDP indicates economic expansion, which is fueled by factors like increased consumer spending, business investment, and export, among others. This growth attracts foreign investments, boosts investor confidence, and leads to currency appreciation. In contrast, a decline in GDP suggests economic contraction. This is marked by reduced economic output, higher unemployment, and weaker consumer sentiment. Typically, negative GDP growth can result in currency depreciation as investors opt for safer assets or currencies with strong economic foundations. One of the key channels through which GDP growth influences currency markets is monetary policy. Central banks closely monitor GDP data to gauge the health of the economy and make decisions on interest rates. Generally, strong GDP growth may prompt central banks to consider raising interest rates so as to curb inflationary pressures and maintain price stability. Also, higher interest rates make the domestic currency more attractive to foreign investors as they can earn a higher return on their investments. As a result, the currency of that given country may appreciate as its demand increases. Conversely, weak GDP growth or contraction may prompt central banks to lower interest rates so as to stimulate economic activity and, more significantly, encourage borrowing and spending. So, how does one trade GDP figures? To understand Forex trading with GDP figures or to understand how to trade GDP figures, let us take an illustration of two countries, the first being the United States and the other being Australia. You will note that if the United States is experiencing growth while Australia is experiencing a decline, it's anticipated that the United States currency will strengthen in relation to GDP. This implies that traders may favor buying the currency of the United States, that is the United States dollar, against or while selling Australia's currency, that is the Australian dollar. An interesting aspect or an interesting case might arise when both countries are experiencing growth. In such a case, the more valuable currency to buy is the one with a faster GDP growth than the other. Traders will assess the pace of economic expansion in each country and prioritize investing in the currency of the country with higher GDP growth than the other. Conversely, if both countries are experiencing decline in GDP, traders will favor the currency with the lesser decline. They will compare the extent of economic contraction in each country and opt to buy the currency of the country with the milder GDP decline. Also, we have to note that trending GDP news in the Forex market requires a comprehensive understanding of economic fundamentals. Also, traders have also to understand monetary policy dynamics and their implications for currency valuations. Typically, by analyzing GDP data releases, also and assessing their market impact or the impact on interest rates and investor sentiment, and most significantly implementing sound trading strategies, traders or Forex traders can capitalize on market opportunities and navigate the fluctuations with confidence and be able to trade profitably. Thank you for watching, and as usual, let us interact again in our next trending video.